Hey everyone, this is Kirk here again at optionalpha.com, and we got a great video for you guys tonight. We're going to go over all of the opening and closing or adjusting trades that we had today. And we're going to start off with a pretty interesting one that we really haven't even covered on a lot of videos, and it's just a really good setup in EWZ, even though EWZ has kind of blown past one of our legs in the Iron Condor. And it's a really good way to hedge a position like this because I do think we're going to see at least a pullback in EWZ in April, which will really help this position. So before I get into some of the opening trades, I want to go over this closing or hedge trade that we made in EWZ. So the first thing you'll notice is that we just bought back one of the legs of one of the sides of our Iron Condor. So we originally had put on an Iron Condor in EWZ, and today we bought back one leg of one side. So all we did was we bought back two, which was all of them, of our 35 short puts. So we went in and bought those back for a 3-cent debit. Basically a very, very cheap debit just to get rid of that trade. So what does this trade look like now? So we'll take this one off. And basically what we have now is we have this kind of almost looks like a very weird looking credit spread, right? So you still have the credit spread on the top side of the market, so the call credit spread that we originally had. But now down below the market, we're basically long 2 extra puts below the market. So I want to add back in the trade that we got rid of today, just so you guys can see what this position looked like before we actually made our adjustments. So here is the original Iron Condor in EWZ, and you can see the profit and loss diagram looks something like this, right? Very familiar with an Iron Condor. Now, EWZ today had a huge move higher and is now trading at about 44.65. So that move is outside of one of the ranges. And that means that it's now testing this upper range here of our call spread. But that also means that our put spread is now really, really, really far out of the money and practically worthless, right? Both of those options are practically worth nothing right now. So what we did is we went back in and bought the 35 put for 3 cents, right? We could have bought it for $1 or $2, whatever the case is. We just got it filled for 3 cents. It's not really that big of a deal because there was only 2 contracts. And by doing that, what we did is we got rid of this 35 short put that we had, which made the profit loss diagram turn downward. So this 35 short put that we had, now that we got rid of that, this makes this put go away. And now we have a profit loss diagram that starts to look a little bit more bullish as far as profit goes as EWZ heads lower. So I'm just going to unclick this thing here on the Analyze tab. And now you can see what our new position looks like. It's very, very bearish on EWZ. We still have that top side of the trade that is a credit spread. So this credit spread is still active on the top side. But we also now have these 2 long extra puts on the bottom side. So really, the ideal situation for us is to see a down move in EWZ at least to the 42 mark, if not much, much further below that. So if it goes much further below that, obviously we make a lot more money, but we don't anticipate it's going to go all the way down to 33. All we're doing here is just trying to take advantage of the fact that we had a quick pop up in the market and we got rid of our short put, which actually made all the money back. And now we just want to position ourselves for possibly a move lower, in which case we make money back quicker than if we just left the Iron Condor on. Now, I do want to go to the trade grid just to show you guys where EWZ is trading, because the one key to this whole thing is the pricing. So the key to all of this, if you ever look at getting rid of just one leg on an Iron Condor, is you got to keep in mind what the price is of that leg that you're still going to be long. So in our case, these 33 puts that we are long could actually expire out of the money. And in most cases, it probably will expire out of the money, right? We're not anticipating it's going to go all the way down to 33. So if it does expire out of the money, we want that leftover price to be as small as possible. And you'll notice that today, that leftover price for those 2 puts that we're holding on to is only $1. So for risking $2 basically with long puts, and you guys know, for those of you who have been on this membership side for a long time, I hate being long just regular options. But in this case, we're long these options for $2, $1 a piece right now. So it's basically as cheap as you could possibly buy an option, and really just a really good bet in case EWZ moves lower. So like I said, we go to the chart of EWZ, you can see had a huge pop up today. So we're basically taking profits on one side of the iron condor and anticipating that at some point between now and April expiration, which is here, that we're going to take a move back down inside at least 44 to get a nice little profit on the other side. So being a little bit nimble, working both sides of the trade here, moving in and out of the market. All right, so that was a huge tutorial on EWZ. And again, really warranted because we don't do that often. The pricing never works out to leave that last leg on for about a penny or so. So really good tutorial to go over it. As always, if you have any questions about it, just ask them right below in the comment section. Now, the other trade that we got out of here today is Citigroup. So we bought back the 2 call spreads, or the 3 call spreads that we had in Citigroup. Now, the name of the story here with Citigroup is that it failed the stress test the other day. So Citigroup gapped much, much lower on the open here today. Really just gave us a great opportunity to quickly take a profit on this one. We bought back all 3 of our short call spreads for a 15-cent debit. So that means that we took in a $50 profit per spread that we bought back. So nice $150 profit on this trade. As we go to the charts here of Citi, again, you can see really the name of the game here with Citi is that it had a huge gap lower on the news. Implied volatility is still fairly high in Citi, but actually has come down from where it was. So we've actually been playing Citi fairly well this last year. So hopefully that continues and we'll get back into this here in a couple weeks. The other one that we got rid of is HLF. Now this one has an interesting story, and I talked about this, I believe 2 or 3 days ago on one of the video tutorials. But HLF is Herbalife, and Herbalife had a huge news announcement that it was under investigation, yada, 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 whatever the case is. It really doesn't even matter. All that we know when we actually traded this, and you go back to the video tutorial when we covered Herbalife, was that implied volatility was high and the stock seemed to be at near lows, right? It was just making low after low after low, and something had to give, right? The market had to shift at some point. Now, we didn't think it was going to happen this fast, but it did, right? So Herbalife since then, since we entered this trade, has moved up a couple of percent. So as it moved up and as implied volatility dropped, that allowed us to then buy back our short 50-45 put spread that we originally had sold. We bought it back today to close out the trade at a $70 debit, so took in a little over 50% of the max potential profit. So we took in a nice $75 profit. It was only a 1-lot trade, so we only traded one of these because it was a wide spread. But again, for a couple days of risk and premium in the market, that's a great return on our money. And definitely we got a nice move in Herbalife. Now, why I say this is an interesting story, because after I made this trade, I got, and I'll actually just show you guys exactly the day that I made this trade. I believe it was actually this day. So I'll kind of cut off the graph here and show you guys. And look, Herbalife was just continuing to move down, 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 down. Implied volatility has dropped now, but it was much higher when we actually sold the spread. Now, I got a bombardment of emails from some members saying, Kirk, everything I'm looking at on the technicals or this or that, or have you heard the news? Have you listened to the stories? Have you read the articles? Everything is saying that Herbalife is going much, south of 50. So it's going to 45, 40, whatever the case is. And while all that stuff is important, what is more important is what's actually on the chart. So that all may have been true. And not to say that it doesn't happen in every case, but in this situation, we kept our trade size small. We only traded a 1-lot. We were trading the right side of volatility, and we made a directional assumption on Herbalife. You could have easily made a call side trade where you sold a call spread if you thought Herbalife was going to continue lower. So long as you're either selling or buying options on the right side of implied volatility, you're going to have at least an edge against the market to make some money. So I just think it was really interesting that after we made that trade, we had 1 day lower, and then after that, Herbalife has moved higher since. So, and implied volatility has dropped. So it's just a really good story. Really, the moral of the story here is that nobody knows where these stocks are going. Technical analysis doesn't tell us. The news media definitely doesn't tell us where these stocks are going. No analyst is going to tell you guys where stocks are going. I used to be in that business. And again, it's all prediction. It's all assumption. All we know is that there's going to be a probability range, and implied volatility is a big factor in that. That's all we can trade. So at the end of the day, I don't know where stocks are going. You don't know where stocks are going. All we can do is make directional assumptions with implied volatility in our favor and keep our trade size small. That is how you beat the game, if you will, in this business. All right, so let's go over some of the opening trades that we had here today. It was all very much the same breed today, and that's all call spreads. The reason that we did call spreads in today's case is because the market was continuing lower. We obviously don't want to sell put spreads any more than we already have in the past. So we needed a couple more negative delta trades, and that's primarily what we focused on today with call spreads. So negative delta meaning that because we're selling a call spread and we want each of these stocks to trade below the first strike here, so 85 in XRT, 118 on the IWM, and 55 in WFM, we're actually kind of bearish on the overall market, or at least bearish on these stocks. Now again, this fits into our overall portfolio because right now we're a little bit too bullish on things. We've entered a lot of put spreads, a lot of debit call spreads, so we'll make money when the market rallies if it does, but we don't want to be overly weighted towards the bullish side. So we want to add some of this great premium in, and all of these had really, really great implied volatility today, which you just really can't get away from. And that's why we took a little bit larger positions in most of these, selling 8, 7, and 2 of each respective trade. So let's go over XRT first. So XRT, we went in and sold the 85-86 call spread. We took in a great credit of 32 cents per contract. We go to the chart here of XRT. The first thing you'll notice, obviously, is implied volatility was above the 50th percentile. When we sold this, it's back down below the 48th. So we're already starting to make some money here, but really our strikes here are kind of above the market. We're giving ourselves a little bit of room for the market to rally. But again, it's just amazing how quickly these things can turn all the way over. I mean, even from back here in December and January, how things just turn all the way over, and we're right back to where we were back at the end of December. And it's not without saying that markets are 100% random and cyclical. At the bottom here, you would have never expected this. And at the top, you would have never expected that we come down so far so fast. So at the end of the day, we still don't know exactly where this is going to go, but we're going to make a directional trade on it. The next one is IWM. This is a great trade because it's so highly liquid and makes the pricing very, very easy to get in and out of. So IWM is the ETF for the Russell, and we sold the 118-119 call spread for a 31-cent credit. Again, with a lot of the other ones here today, IWM had a really tough day, and by selling the 118-119, it puts us back above the recent highs for May. Gives us, again, a little bit of room for the market to rally, obviously, but what we really want to see is we want to see implied volatility drop. So it's already dropped. Even since we entered this trade, it was up around the 57th percentile when we actually entered this trade. And right now, we just want to see that implied volatility continue to drop. I'll actually go to the trade tab here of the IWM just so you guys can see exactly where our strikes are positioned. And what you'll notice here is that all of our trades, we took in a credit of about 1/3 the width of the strikes. So if I'll go back here just quickly, you'll notice that the width of the strikes here is about $1. And we took in a credit of 31 cents. So that means that we're risking 70 cents roughly to make 30 cents on this trade. And we want to match that risk reward to the actual probability of losing money. So if we're risking 30 cents to lose 70 cents, then we obviously want to trade with 70% chance of success. If we do anything less than that, then that means that we're not being compensated enough for the amount of risk that we're actually taking in the market. So we go down here to the IWM, the trade grid of IWM. Oh, let me just go back here. So we go here to the trade grid of IWM, and you guys can see that our strikes are right here on the left-hand side at 118 and 119. And right now, the probability of being in the money for our first strike at 118 is about 30%. It's actually just a little bit less than 30%. So you can see that the probability of IWM closing and rallying above 118 by May expiration, which is about 50 days away, is about 30%. And we were actually compensated fairly. Now, this only really happens when you have really great volatility and you have really great volume in the underlying security. You'll notice that today, IWM traded almost 65 million shares. And look at the options. The options are very, very active for these particular strikes. So on both sides, we see a lot of activity in the options, which is really good. It makes the bid-ask spread very, very tight for these, easy to get in and out of. All right, the last trade that we want to go over tonight is WFM. We sold a 55-60 call spread, so it's a little bit wider spread. Took in a little bit smaller credit than we usually like to take, but we kind of moved away from this thing a little bit more just to get some distance from ourselves in the market. If we go to WFM, you guys will take a look at this one and see that it also has continued to move lower pretty fast. Whole Foods moving much, much lower here after the first of the month. Now you'll notice that implied volatility is still very, very high. Whole Foods kind of closed at the lows. Now our first strike here is at 55. So by putting that first strike almost right at the recent highs, we're giving ourselves lots and lots of room between ourselves and the market. Whole Foods can basically retrace this entire move between now and expiration, and so long as it doesn't go past 55, we'll still keep all of our premium. I assume that we'll probably get out of this trade well before expiration, but if we need to hold it all the way, we absolutely will. Implied volatility up around the 53rd percentile. This gives us a great opportunity to make some money even if Whole Foods starts to rally. Implied volatility should drop and our option premiums should start to decay. So this is another great trade. Again, a great volatility trade for us that we want to add to our portfolio. All right, so hopefully you guys enjoyed this video. As always, if you have any questions or comments, please add them right below to the comment box here. I'll get back to all of those either tonight or tomorrow before the open of the market. And hey, if you're watching this video on YouTube or somewhere else and you're seeing this and you're not getting these alerts, you just have to understand that these alerts are only published for our members the day of that we send them out. You're actually watching this video with alerts from about 7 to 10 days ago. So if you want live alerts, as well as this video sent out the same day that the trading alerts are sent out, you've got to go to our website at optionalpha.com and sign up for our membership. Other than that, I hope you guys enjoy this video and happy trading.